Hello, my name is Jonathan Greenstein and welcome to today's webinar on EMiR and MiFIR reporting hosted jointly by ComplyPort and MAP FinTech. I am joined by two leading experts in this field, Graham Levy-Samper, an Associate Director at ComplyPort, and Alexandros Konstantino, a Director at MAP FinTech. Graham brings over 10 years of consulting experience and has worked on numerous regulatory and transaction reporting projects. Internally in ComplyPort, he is one of our leading consultants on the topic and often provides best practice advice to our clients. Similar to Graham, Alexandros is a regulatory and transaction reporting subject matter expert with over 10 years of consulting experience in transaction reporting. MAP FinTech is an award-winning regulatory reporting fintech firm that has been helping financial services firms with reporting for the last 5 years. Before we start properly, I'd like to cover some brief housekeeping points. Either at the top or bottom of your screen, depending how you have it configured, you'll see a button called Q&A. If you have any questions, please ask them there, and we'll try and get through as many as we can at the end of the discussion today. Please do not post any questions into the chat function, as this will not be monitored. If everyone's ready, let's begin. Graham, our first question is for you. What are some of the latest regulatory developments within MiFIR transaction reporting?
Thanks, Jonathan. Nice to see everyone here, and thank you for joining us. Hope you'll find it informative and interesting. In terms of transaction reporting, since MiFID II came into being and the number of transaction reporting fields went from around about 23 to 65, there's not really been a huge amount of changes since then. There's been clarifications, guidance, ESMA's come out with question and answers, quite a voluminous text on how to actually fulfill your transaction reporting obligations. More recently, ESMA's Q&A has been updated, in particular section 22 for transaction reporting, and looking at question 2 with amendments to national identifiers and identifiers for the national, for individual people and natural people that are to be used. In terms of that, also question 13 is a new question which basically clarifies around execution where an algo is involved from another investment firm. So investment firm 1 executes a reportable transaction using an algorithm of investment firm 2. Then investment firm 1, the one that's actually placing the transaction or using the algo, should only populate its own info and not the other investment firm's algorithm, the idea of that algorithm. More recently, and probably quite relevant to some people here, ESMA's AIFMD review letter, which came out a couple of weeks ago now, on the 18th of August. If you have a look at page 5, paragraph 3, it talks about the Article 26 obligation of MiFIR not being included in the provisions applying to AIFMs and UCITS management companies. So obviously, and as really suspected, probably by most of the industry and most of the consultancy firms and most experts around the field, they left a massive hole in the transaction reporting for basically for managers of AIFs and UCITS. So the likelihood is that any further review of the AIFMD will see, or indeed UCITS will see those firms be captured by transaction reporting requirements. So that's going to be an increased burden on them, and potentially then in terms of the funds they manage and then the investors, because I'm sure costs will end up being passed on somehow. Following on from that, I suppose really that then prompted, or has prompted, over the sort of the last 2 years since MiFID has been around, or really since the NCAs have been focusing on it. NCAs have been doing reviews and sort of lessons learned and putting out publications really. I suppose historically you could start with MarketWatch 59, bring it all the way up to MarketWatch 62 in October last year. All really seem to be identifying similar issues. The good news is that from 59 to 62, in terms of the market watches, time didn't seem to be so much of an issue anymore, and price was being rectified by the majority of firms, except where firms were putting in the correct price, they were using the incorrect currency for basically for the price that they were indicating. But I mean, you look through, and FCA has basically come out and said, looking at transaction prices, looking at buyer and seller misreporting, National IDs were being used incorrectly, and even now, basically unique national identifiers are not being used correctly. Sometimes where there's a primary, as people that are probably aware of it, where there's a primary national identifier or primary choice for a national identifier, that must be used if it's available. If it's not available, then you can use the secondary or tertiary ones. But firms have been apparently submitting, or according to the FCA, the firm's been submitting secondary and tertiary identifiers where actually a primary one's. On top of that, recently we've had discussions with the FCA where they've effectively come out and said, and also on the back of their letter that they sent out recently to firms, ensure you're using your permissions correctly. As long as you're within the scope of your permissions, it doesn't mean that you can't report, let's say, deal in a particular circumstance. So for some match principal firms, it may be the case that if you meet all the criteria of being a match principal trade, or of your transaction being matched principal, you could, in theory, report deal, but the FCA have said that they would want to see evidence of how you've actually met all the conditions of being a match principal, of that transaction being a match principal transaction. So the key message from them was, the trade report should basically match both your permissions and your capacity that you're trading in. The other thing the FCA has also said is that errors and omissions is a major downfall. Firms are not submitting errors and omission reports in a timely fashion, and in turn, they're not then resubmitting transaction reports where there have been errors. And the FCA is just reminding firms rather consistently that it's an obligation under RTS 22 and Article 15 that NCAs have to receive these error and omission reports in a timely fashion. That's largely it, and then we'll cover some of the other things as well when we get on to sort of looking at maybe common errors and things like that.
Thanks, Graham. Alex, similar to the last question, what are some of the latest EMiR transaction reporting regulatory developments?
Good morning, everyone, from my side as well. Pleasure to be here with you today to discuss these important topics, and hope you find this webinar useful. So, Jonathan, thank you for your question. There hasn't been much, I would say, lately. The only noteworthy development has been the updating of ESMA's EMiR Q&A document in July, where the updated Q&A in question 11 has been amended and now clarifies how working day should be defined for the purposes of determining the deadline for reporting, and whether counterparties should follow their local calendar and time zones. That was a question that was amended, basically. ESMA clarified that counterparties should follow their local time zones and calendars to determine the day on which the derivative was concluded, modified, or terminated. So the deadline for reporting, the T+1 deadline, is the next working day following that day. Obviously, although different counterparties in Europe which follow different calendars and different time zones need to follow their local time zones and calendars, the reported, of course, format of the time and date should be the UTC time format, obviously. Another noteworthy recent development is the go live of refit. As you know, in 2019, the EMiR regulation has been amended with the so-called refit. And we've seen that there's been some changes back then with respect to reporting. One of the changes was as of 18th of June earlier this year, financial counterparties are now responsible and legally liable for reporting on behalf of non-financial counterparties below the clearing thresholds with respect to their OTC derivatives entered between them. And financial counterparties are responsible to ensure correctness of the details that are reported. It is possible, though, that non-financial counterparties below the clearing thresholds to choose to report their own transactions, assuming they inform their financial counterparties accordingly. Also, despite that the responsibility for reporting has been shifted to financial counterparties, the non-financial counterparties should provide the details relating to the derivative contracts that financial counterparties cannot be reasonably expected to possess. For example, the sector of the counterparty. ESMA in its Q&A, EMiR Q&A document has clarified quite well what are the informations that the non-financial counterparties are expected to provide to their financial counterparties. Also, in relation to UCITS NIF's management company, the management company of a UCITS and a NIF fund will be responsible and legally liable for reporting on behalf of that UCITS or NIF fund with regards to the derivative contracts to which the UCITS or NIF fund is a counterparty, as well as for ensuring the correctness of the details reporting. So that's about it with respect to recent updates on EMiR forefront, Jonathan.
Thanks, Alex. Graham, within your experience, what are some of the common errors you have observed in the market in relation to transaction reporting? And furthermore, what compliance procedures should be in place to avoid these errors in the future?
Okay, I think largely along the same lines as the FCA have seen, when we've undertaken projects to review transaction reporting and sort of whether firms are meeting their obligations, it all falls down. There's a long list. I mean, some of the key ones really are trading capacity, IDs, so whether the correct national identifier is applied, whether the correct LEI is applied, and making sure that actually when you're populating things, that the buyer and the seller is populated correctly, whether it be an individual, whether it be another investment firm. The failure to submit error reports is a big one, because FCAs have basically started losing patience, I think, now with firms. They gave everyone, obviously at the start of MiFID II, they gave everyone really sort of a 6-month grace period to let everything bed in. But now almost, I suppose, we're getting to sort of the 3-year mark, or will be near enough. Patience is wearing thin, and you can see that in the level of the fines that have been being levied, certainly last year, or towards the end of last year, against 3 of the large investment banks. Wrong reporting of contracts on futures is another one, so reporting after the maturity date. Late reporting, so after T+1, whether that be the investment firm's fault or whether that be the arm, it's really, the obligation rests on the investment firm. Resubmission delays, and then no remediation being put in place afterwards. So if a firm has made a transaction reporting error, there's delays in resubmitting those transactions, and then there's no coherent or clear remediation plan that's been agreed either with senior management or with the transaction reporting team in-house and with the FCA. A lack of monitoring. There seems to be a distinct lack of sort of 3-way, if you like, reconciliation, and that's one thing the FCA has come out with in saying to certain firms that we've certainly seen, is that there doesn't appear to be adequate reconciliation processes in place between basically the firm to the arm to the FCA, and then basically the firm to the FCA. It's also the other, I think, a common mistake, and this probably tallies into or segues into the compliance procedures, is that reporting is often seen as basically back office, and it's effectively a cost center. It's not really earning anyone any money, whereas the trading side of the business naturally is. So it's not generally given the priority it's needed in some cases that we've seen. Transaction reporting is an obligation under MiFID. The fines can be huge depending on the volume and the amount of transaction reporting issues and errors that occur. I think the key thing is basically to ensure that you've got the proper procedures and processes in place to identify promptly where there are any breaches or where there are any errors, and then to correct that and report it again promptly, and to inform the FCA or whichever national competent authority you're dealing with about your plan and what you've actually then done to put everything in place to make sure that you don't have a repeat of the same mistake. As I've said earlier, the other compliance procedures really are 3-way reconciliations. every investment firm or every firm that's executing a transaction should have access to the MDP to basically be able to go and get sample data. It's easily accessible once you get through the FCA's various hoops to get access to that system. You can then download or request a sample of data and you can review it appropriately. It really depends, you know, the level of appropriateness will depend on your volume of transactions. If you're doing very low volume of transactions, then you may only need to review it quarterly or semi-annually. I would generally say no less than quarterly. If you're doing a high volume of transactions, you may want to review it weekly. You may want to review it even more frequently than that. It really does come down to volume and available resource and whether you've got a system in place to actually help you monitor it. I suppose the last two really are the people side of things and the resource side of things. Making sure you've got enough people involved in the transaction reporting and that those people have the knowledge and understanding, or at least they can reach out to people that have the knowledge and understanding to be able to assist them, and that systems are in place and controls are in place to make sure that, you know, any errors are picked up and identified. And also that those doing the transaction reporting or making sure that the reports are correct before they submit them, know what needs to be and what doesn't need to be reported. And that really, you know, it is almost as simple as that once you get to grips with, you know, what needs to be reported and what the requirements are of those 60-odd fields.
Thanks, Graham. Alex, ESMA has recently highlighted the importance of data quality in its recent EMiR peer review. In your opinion, what are the key takeaways from this?
Yeah, thank you, Jonathan. Well, one of the many objectives of EMiR is to aim to reduce and identify systemic and counterparty risk and help prevent the future financial system collapse like the ones we saw back in 2008 by requiring, obviously, all participants in the derivatives market to report their transactions to TRs. Now, this objective is achieved when high-quality data is reported by counterparties to the TRs. So the peer review was undertaken as there was a concern that the quality of data may not have been as high as would expected. This is what the first years of EMiR reporting has shown. In this respect, peer review confirmed that the results of the peer review confirmed that there is a room for improvement for data reporting. And NCAs supervisory actions in this area. ESMA expects from the national competent authorities to integrate an assessment and analysis of EMiR data quality into their overall supervisory approach. And therefore, NCA's actions is expected to focus on areas such as accuracy, completeness, consistency, timeliness, and the non-duplication of reporting under EMiR, to just list a few here. So in light of ESMA's peer review findings and recommendations, which is a quite interesting report, by the way, we expect in the near future an increase in supervisory activity by the national competent authorities with respect to EMiR data quality. Now, given this, reporting entities should ensure not only that they report their transactions on a T+1 basis, but that they also provide accurate and up-to-date and meaningful information to TRs. So in the initial stages of EMiR reporting, you know, most NCAs made sure that reporting parties would report their transactions and not miss any out, and that the reporting takes place according to the time frame of T+1. But now the focus is not on that only, but to review the actual reports that were submitted, whether the data are accurate, up to date, and meaningful, so that EMiR can achieve its objective.
Thanks, Alex. Now, a question for both panelists, whoever would like to go first. In May earlier this year, we saw the announcement from CME that they are planning to wind down their European transaction reporting and their Australian transaction reporting businesses, as well as Next regulatory reporting, which was formerly Abide. What issues should reporting participants and firms need to consider when switching from one provider to another?
Okay, Graham, you want to take this first, or shall I do it?
I don't mind. I mean, it's really, I think it's going to be largely the same thing we're going to say. Any switching providers will always, outsourcing. You'll need to ensure that you do, follow the FCA's guidance on outsourcing and doing due diligence. Certainly from an FCA standpoint, and I imagine it's pretty much the same for all the NCAs. If you're outsourcing any particular aspect that could impact your regulatory, your regulatory affairs or your standing with the regulator, make sure you've done sufficient due diligence on that provider and that you're comfortable with how you're going to be switched across, what method you're going to be using, how you're going to get access to your past data, how are the two suppliers going to communicate with each other? Are they going to communicate? Are you going to be able to get the data from one to be able to then transfer it to the other? Will you have to do the bulk of the work? Will it be done for you? I mean, costs obviously are a paramount consideration. Expertise, making sure that you can carry on basically in a seamless fashion to continue to meet your reporting obligations, basically. And also how will they deal with open positions? What if you've got a trade that's currently running, and you're due to settle it and you're due to report on it? What happens midway through that process? How will that then be reported? How will they ensure that it's correctly reported? There's a whole raft of questions that can be asked, and I mean, I think it's really down to each firm and each type of product that you're dealing with as to what questions need to be asked of the new provider or of any provider, really. And you could be doing your due diligence in a similar fashion on a regular basis. What benefit are you getting for the costs you're paying this particular provider?
Absolutely agree with you, Graham. I would also say that the reporting entity needs to evaluate what is important for them and identify their strengths and weaknesses in terms of in-house reporting capabilities. For example, does the reporting entity have in-house expertise, technology, and means to handle by itself reporting directly to TR, or does it need to use a third-party vendor's solution to achieve reporting? Another question that could be asked is, does the reporting entity have in-house compliance expertise to ensure accurate reporting, or does it need consulting level support along the way? Now, these are important questions that should be asked by reporting entities, and those should influence the decision of a reporting entity how to perform the switch and which provider also to choose. Other important things that need to be considered as well is to choose a vendor or a TR firm which is well established and has sufficient experience. Reporting entities need to also analyze the requirements of the third party and the methodology of switching. I would say choose a vendor with a variety of connectivity methods that offers flexible integration process. The timing, I mean, how much time will integration and switching take place? These are, again, an important factor that the reporting entity needs to consider. If you need specific customization, does the third party or the TR offer this? These are, again, crucial, as some parties may need this. As you mentioned before, the costs, again, is a crucial element. Again, some participants have extremely high volumes. Is the vendor or RTR able to accommodate your volume? the open positions that you mentioned, this is again a very, very valid point. Will you be able, or will the new vendor be able to provide you with the facility to handle these open positions? Also, another point to note is, does your new vendor offer efficient maintenance and monitoring of your reporting? Does it provide facilities, for example, to handle your errors, export reports for record keeping, provide you facility to perform your relevant reconciliations? Do they provide a friendly interface and reporting process? Another thing that could be also considered is whether the new vendor allows you to perform delegated reporting, especially with the refit into place now. Financial counterparties should be able to perform the reporting of their NFCs themselves. In addition, some advice I would say to companies that are about to switch vendors or TRs, you need to be proactive in your in this process. Don't stay at the last minute to switch and migrate to the new provider. You need to do proper testing before the switching. Try to do the switch and migration during a weekend so that it allows you some time to correct any potential unforeseen errors. Once you have migrated and switched to the new provider, try to monitor closely your reporting after switching and do frequent reconciliations to be able to spot errors from early in the beginning and rectify them accordingly. Also, ensure your outstanding positions are transferred correctly. Yes, your data from one TR to another, there is a procedure and guidelines issued by ESMA when porting data from one TR or run to another, and the open positions, but you need to make sure that you know your positions, your open positions especially, have been properly transferred. You could also request a copy of the data that you have already been submitting to the TRCNR for your record keeping, and just in case there's something in the process that would possibly go wrong, to keep them there for future reference. So these are things that participants need to consider when obviously switching from one provider to another.
Thanks, Alex. We are coming towards the end of our allocated half an hour here. So I would like to thank all the attendees on today's webinar for joining us for this interesting discussion. Graham, Alex, thank you for giving us your time today as well. If anyone has any questions regarding anything discussed here or would like to provide any feedback, you may have noticed that I have just put my email address in the chat function of this webinar here. Please feel free to email me and we'll be happy to try and assist. From everyone at ComplyPort and at MAP FinTech, thank you very much for joining and looking forward to speaking to you soon.
Thank you. Bye-bye, everyone.
Bye all.